Gabriela, Bullard's more on the market side of the coin when it comes to the Federal Reserve cutting rates, but the center of the Fed does not seem to be there. Is that going to be a problem for this market?
Yes, I think when we look today at the minutes when they come out, I think the inflation question is crucial to understand where most members of the FOMC are. Are most members with Bullard, thinking that some of this transitory fall in inflation might not be so transitory, it might actually warrant a rate cut? Or are most members with Chair Powell who do believe that this is transitory and a pause is enough to deal with the inflation question? I think that's up for grabs at this moment. We ultimately still think this is a Fed on pause, and we ultimately think, of course, the trade issue is very important. If it escalates further, then a cut really would be warranted.
Why is the market so convinced that the inflation picture is not transitory?
So I think there are two major themes going on. There's a structural disappointment in inflation, and then there's a more transitory dip to 1.5% that we saw in March with the PCE numbers. So I think there's a struggle between distinguishing between the two. We're more in the camp that some of the cyclical fall is transitory, while there's still a structural issue reaching 2%. But I think it's still very unclear where the Fed falls on this, and that's why the market's having a tough time pricing that in.
Brian, where do you think the market is right now on Fed policy? Is it helping the stock market still as it was sort of in the early part of the year when the celebration occurred over the big pause and the pivot?
Yeah, well, I think that the way that the market is pricing in it with Fed funds futures and the such, as far as the probability of there being a rate hike, has probably helped the equity markets. If you expect that the Federal Reserve is going to be easing monetary policy going forward, that tends to be a bullish signal for stocks. But it's also important to caveat that with the idea that, well, why is the Fed likely to ease? And it's not necessarily because growth is going to be is projected to slow dramatically. It's more because the Fed is missing with its inflation target. And so if it's because inflation is a little bit lower than what the Fed is looking to hit, then that should continue to be a relatively bullish signal for stocks. I'd be really concerned if the market was pricing in a cut because growth was slowing. So it's important to distinguish as to why the market is pricing in what it is. As far as with Bullard's comments, I think it's important to remember that he's been a bit of an outlier when it comes to the summary of economic projections, where initially when they started with rate hiking, he effectively said, well, let's do it once and then just never hike again, right? And I think that I'm actually somewhat sympathetic to that view because his reasoning was growth is good, inflation isn't bad, so why ruin a good thing? And in a way, I think that he's been maybe arguing against further normalization of monetary policy. And it's just, I think he's reiterating that statement again, is that kind of like, I told you so.
Yeah, that's why he's so interesting. He's a voting member. He said he's not worried about the impact of the Chinese selling treasuries. Says we overdid it in December probably. And then he said if tariffs were in place for 6 months, that there's some magic in that in terms of leading to a rate cut. What'd you make of that?
So
well,
I think the Fed doesn't want...
I'm sorry, I was asking G. So, go ahead.
So I think the Fed doesn't want to preempt any sort of impact of the tariffs, right? It wants to actually wait and see. Is the heat high enough that it actually impacts consumer prices and consumer spending? And is the smoke in and of itself, the uncertainty, strong enough that it starts impacting business spending? So it wants to wait and see the actual impact. And I think it also wants to wait and see if we turn up the heat further, right? Which I don't think we'll know for another few weeks, maybe even a couple of months.
So, Brian, I mean, similar question on where the market is on what the impact of all the tariff damage is going to be. It's what, 3.5% off the highs here, the S&P 500. I mean, what does that signal about what the market is expecting in terms of the economic cost of this trade policy?
Sure. I think that what the market is signaling is that there is indeed an economic cost to an increase in tariffs. However, those costs might not be as dramatic as what a lot of people are probably fearing. If you think about if we go to 25% tariffs, is that where it stops? My guess is that under the Trump administration, they would hike it to 25% and probably keep it there. So this is nothing like we saw during, like, say, in the 1930s with the Smoot-Hawley tariffs, where tariffs went up to, say, 60%, and in some cases even higher. So as long as it's not a game of escalation, if it just is where the rate gets capped at 25%, I believe that there is downside for the equity market, but it's probably not as bad as what a lot of people might be fearing.
Gabriela, you've, I think, previously advised people to certainly look not just domestically, but for global equities. Yeah. What is going to be the impact if we continue to see escalation in terms of China versus the U.S. for Europe, for example, and other global economies? We
are getting a little bit more concerned about this. And I think the issue is the actual escalation, the turning of the heat further to the 25% and the remaining $300 billion. That's actually a very strong fire that would be burning. And that's not just for China or for the other economies that trade with China, like Europe, like Japan, like the rest of EM Asia, but it's also an issue for the U.S. economy, and that probability has gone up. So what we've really been advising clients at this point is make sure their portfolios are right-sized, that there's more of a neutral balance between equities and bonds. Within the equity side, that maybe there's a better balance between growth and value, maybe some hedges for downside protection, maybe a little bit more of a U.S. focus now than we had thought before, maybe even just 2 weeks ago, and on the bond side that there's Treasury for protection.
Finally, Brian, you want to be defensive or you want to be cyclical? Lately, the market's being led up by utilities and consumer staples and the more traditional defensives, but so far for the year, it's still technology on top.
Sure. Well, exactly. And I think that the most recent events that we saw as far as with value outperforming growth and more defensive names outperforming, it may just be somewhat temporary because, as you point out, year-to-date technology is the leader. On a lot of our portfolios, the way that we're managing it on the multi-asset solutions team is we went from a very pro-cyclical position to a more neutral position. So I think that it's not necessarily a matter of go cyclical versus go defensive. It's maybe just stay neutral. I think that my friends over at the Wells Fargo Investment Institute have a year-end target for the S&P 500 of around 3,000. That seems pretty reasonable to us. Still some upside from here, but not a tremendous amount of upside. So I think that really it's making the argument for just keep it neutral for now, and then you can always make an adjustment later.